Yes, hello everyone. Today we'll be looking at liquidity and the key areas of liquidity are going to be a very significant role in our trading today. We'll be looking at the fact that liquidity is the lifeblood of the market, and since liquidity is the lifeblood of the market, you realize that we need to identify them quite well. You need to identify the different areas that have liquidity and also the areas that have no liquidity, so you can benefit from trading together with the institution, as we believe that the institution is the one to deliver price of liquidity. And the layman's language for liquidity is money. So since liquidity is simply money, it means that we need to understand where there is money for institutions to pair them before they deliver to another side. So we'll be looking at liquidity, and we'll break it down into three particular areas. So liquidity is a very important aspect of the market, but then we need to identify the right liquidity to use while trading, because not everything on the chart is going to be valid liquidity. So for us to be able to very well benefit from that, we need to first understand the different types of liquidity. There are three. So if you go into other people's teachings and analogy, you realize that there are different ways people look at liquidity. For example, someone can say the whole chart is liquidity, and indeed it's true, because for this single candle here to move, it has to have been able to pair orders at a particular point before it continues expanding higher from a different price level to another price level. So from this price level of 1.10000 to this price level of 1.09066, there has to be exchange of liquidity between buyers and sellers here. For this candle to form from open, high, low to close, there has to be transaction of money here. So you must be able to do what? You must be able to identify the right liquidity. So here are the different types of liquidity. We have the major liquidity, then we have the medium liquidity, and then we have the minor liquidity. So institutions focus on the major liquidity and they do not look at these medium liquidities. though it doesn't mean they're not significant. The medium liquidity and the minor liquidity help us create our trading entries and then also pattern formation. But institutions focus on major liquidity. So the major liquidity comprises of these particular time frames. So we look at time frames here, the monthly, the weekly, and then finally the daily. So this is where institutions focus on their orders. That is widely by research and all that. So you realize that the institutions focus their contracts and orders on the monthly, weekly, and daily because they do more of large orders compared to us who use the smaller orders. So you need a lot more volume to determine market direction compared to us who use the lower ones. So they focus on monthly, weekly, and daily. So that is for the institutional time frame. And also it gives us its role, which is direction. So now this monthly, weekly, daily is for, of course, the general trend of a particular direction when it comes to using liquidity, leave a price. However, a scalper can decide to say my time frame is the 4 hour or the 1 hour. So that one is a different case. But we're talking about the major liquidity that gives us the delivery of price. A 1 hour delivery by a scalper can be short term. That's why it is not major liquidity. When you use a 1 hour as your highest time frame, as well as major liquidity in a scalping, you realize it is not going to last for long because it's a lower time frame. So the next time frame is the medium liquidity. So the next liquidity sort of pool is the medium liquidity. This liquidity comprises of sessions. So under sessions liquidity, we are talking about the Asian session, the London session, and then the New York session. So the medium liquidity comprises of Asian, London, and New York session. So where do we find the liquidity of these particular sessions? We find them on highs and lows of these particular sessions themselves. Okay. So if we go to the 1 hour chart, just to show us the different session liquidities, which is the medium liquidity. I'll talk about the role and how to trade them also. So these are the session highs, session lows, session highs, session lows, session highs, session lows. So you should be able to identify them. So here I've been able to convert the time into Ugandan time to make it easy, but I use New York time for me. So this is UTC positive 3 or UTC plus 3. It is Nairobi time zone. So New York session begins at currently, since we are having daylight saving in the US, it is -5. So the New York session begins at 1 a.m. in Uganda and then closes at 8 a.m. in the morning. That is midnight in the US. And then London session, the kill zone will begin at 10 a.m. in Ugandan time and then stop at 1 p.m. in Ugandan time. And then New York session will begin at 4 p.m. in Ugandan time and stop at 8 p.m. in Ugandan time. So this is now sessions. So the sessions we are focusing on session high liquidity, this session high liquidity, this session high liquidity, session low liquidity, and then we also have London high liquidity, and then London low liquidity. Then we also have New York high liquidity and New York low liquidity. So these liquidity zones are runs for medium. They are very key for intraday trading for us who are intraday traders because they always give us the point of interest when it comes to reversals intraday. So you realize they give you the structure for a day, for an intraday trader or a day trader. Then they can also act as reversal points. For example, this is a short-term reversal after sweeping of this London session low. So this is a major one though. So these are session liquidity points. We're going to talk about how to use them in your trade. These ones. So now after understanding that we have the major, medium, and minor, now you need to identify how to use each of them. Because now the minor liquidity we've not spoken about. Then the minor liquidity are found on lower time frames like 15-minute time frame and 5-minute time frame, 1-minute time frame, a seconds time frame. So the minor liquidity are going to be those lower lows, higher highs found in a small part of a trend. So you see these, for example, these, they are not sessions and nothing, they're just lows that are found inside a price movement. This one, this is minor liquidity. They are not major. This is minor liquidity, minor liquidity. This is also minor liquidity. This is also minor liquidity. Any kind of higher high that is within a price leg, as long as it is not higher than what? As long as within the price leg outside the time window or even within, but not specifically the kills on itself, is a minor liquidity. Even these lows are minor liquidity lows, minor liquidity highs, minor liquidity lows. They're minor. Reason being they're not significant when it comes to volume presence. So we focus on medium being sessions highs, sessions lows, major being previous days highs, previous days lows, previous weeks highs, because they have the most volume of price. So let's go and see how to use the major liquidity. So now, if we are to go back into the, the higher time frame, so we have an example of the Euro US dollar chart, and we say that the higher time frame liquidity, which is the monthly, weekly, and daily, are for direction of the day or direction of maybe the time frame you're trading. If you're a swing trader, then the weekly is a directional time frame for you to trade 1, 2, 3, 4 days. Then if you're an intraday trader, the daily is a directional time frame for you to trade the intraday. So we need the major liquidity for us to control the movement of price in lower time frames. So let's take an example of this particular. So this is a daily chart. There's a difference because you should know when you're going to use liquidity and when it is not there. And then also you should also know when you're going to use PDRAs instead of liquidity. The PDRAs are order blocks and fair value gaps and then inversions and all that. But then there are times when they won't be there. What you will need is liquidity. So then there are times when it pairs up with maybe a PDRA at the same time. So let's take a look at this price action here. So this price action here shows that the price is in a bullish market. You can clearly see price is in a bullish market and it is targeting these lows down here, targeting these lows down here. So if price is still targeting these lows down here and it hasn't yet reached, you realize that if price is, for example, up here, we're looking for the kind of trading that we're going to consider. So for price to move from up here to down here, it will use two models. It will either use liquidity or it will use PDRA. So to come down, to break down to reach this sell side liquidity, because this is also liquidity. It's a swing point liquidity, of course, sell side liquidity. So sell side liquidity, you realize that price comes down here. This is our area of interest. So we're imagining price is up here. So how would we be able to sell this price down here? Okay, we need sweep of highs. I think you're noticing the difference here. When price wants to come down here and wants to use liquidity, it will take highs. Okay, it will be able to take highs within this particular range. So where do you find these highs? Since this is a line chart, you'll find them in form of candlesticks. So this can be a daily candle. This can be a daily candle here. So if I can draw this here and change the setting. Okay, so if we want to sell price in this downtrend and then price is, for example, looking at this as a daily candle. You want to make sure that if this candle has a high, you want to sweep this candle's high and then sell this price lower for it to use liquidity. Or else, if there isn't, that means that you're not going to use a liquidity mode, you're going to use something else. You're going to focus on another kind of model. The daily chart, it needs a bigger gap. So you would use a different kind of model. So if price is going to say it's going to sell, it means that it has to take the previous day's high for us to use the liquidity model over sell. So price has to do something like this. Price has got to rally up, sweep this liquidity before it can give you any reason to go short or to sell. So this will be a liquidity model because price has used sweep of liquidity of previous day's high to sell. Means that we have taken the previous day's high and then our price is going to sell short. So this is a liquidity model. But then you realize there are times where price just continues dropping off. For example, what you're seeing here. This in my analysis, in my trading system, I added it as the aggressive schematic because price does not show you any strong zone it is sitting on. It is just popping down. This shows price is extremely aggressive. It does not use any liquidity or PDRA. So it will just drop targeting its zones. Take an example of this. Price reacts on this order block. After reacting on this order block, for us to say we're going to use the liquidity model, price has to come back up and sweep this high to drop. What does it do? It just continues dropping lower. Then we also have this high. For us to say price is using a liquidity model, what does price have to do? Price has to come back up, sweep this high before it can drop lower, isn't it? We got a lot of time for us to sell, but price does not come back up here. So it shows that this is not going to use a liquidity mode. It's just aggressively dropping lower because of strong volume. Another same thing here. If price is to use a liquidity mode, it has to take this high here. But then what does it do? It fails to come and take it. So this high now again is here. Remember, our target is to come to this liquidity zone. So for price to reach that liquidity zone, it has to take highs to use liquidity. Or else you shouldn't find yourself using sweep of these lows to go up. The reason being you're looking for a sell program. You're looking for a targeting of these lows. So when they sweep these lows, don't get in a false market strategy to go up. Keep your trading bias constant and confirm your real trend. Don't change your bias. The price drops, gives a false buy, continues dropping, sweeps the low, gives a false buy, continues dropping. Our interest is we want to sell, so we want to take highs, not taking lows. So what happened is now finally on this day we now have a liquidity model. Reason being, price swept a high, and also on the process of sweeping the high, what did it do? It also tapped into a fair value gap. But let's focus on liquidity. So this is the liquidity model here. So now finally we've gotten a liquidity model. So what do we want to do now? We want price to rally up and then mitigate this high. After sweeping this high, then we can now say we want to continue going down. We want price to do what? We now go to the 1 hour chart. Okay. So we now go to the 1 hour chart. So this is the scenario that happened there. So price finally swept this high, and make it clearer here. Price finally swept that day's high. Now we want to ask ourselves which kind of liquidity has been swept, because this is major liquidity. So major liquidity gives you normally the trend. So this is the daily high. So since price swept a daily high, we now want to ask ourselves, what else? Do we have any medium liquidity sweep? So we now put our sessions indicator. So we see price swept. This is Tokyo session. Then it rallied up, came London session, failed to sweep the previous day's high. Finally, we swept the previous day's high, and then price began to drop. So now I want to look for an entry. Now, after the 1 hour, you now go to the 5 minute for an opportunity after the sweep here to get your trade. So you go to the 5 minute chart finally. So your 5 minute chart is now clear here. So what do we look for on the 5 minute chart? We're looking for an opportunity to continue selling the price lower. So we look for a market structure shift and then a fair value gap. So there is a fair value gap very clearly here. There's a fair value gap here. So what do we want to do? We want to short price from that fair value gap and then target the opposing end of the price. So price has swept the daily high major liquidity, has given us a market structure shift in the 5 minute chart inside the kill zone, which is New York session. So what do? You sell targeting minor liquidity. Minor liquidity, these lows here. These lows you're seeing down here. These lows you're seeing down here. These lows you're seeing down here. So targeting these lows. So now this is a session low, so it can be a decent target. The price comes until this low to sweep it. So what happens is you now put your entry from somewhere here. From this FVG zone. Open up here, there are a series of candles. So our FVG zone is here, and then price is going to short using a risk reward. This is 1 to 3 is going to be somewhere here. You don't need a lot of pips. The 1 to 3 is going to be somewhere here. So you risk 10 pips to make 30 pips. Or you can say, so I'll target the whole liquidity. So I'll target all these lows until this zone. So you target it until down here. This is 1 to 5 RR. So you're risking 10 pips to make 50 pips. That is how you're going to have the use of liquidity. So what did we do? We go back to the daily chart. Which kind of liquidity do we use? We use the daily liquidity zone, which is strong to give us direction for the day compared to the lower time frame liquidity. So if we are to look at this critically well, so you can see this price swept this high of the previous day, this previous day's high, then reversed. We go to the 1 hour to see if we have a displacement that is confirmed. The displacement is done. Then we now go to the 5 minute for an entry opportunity. Those 5 minutes will always have the entry for you. It is much refined. So yeah, it is. We're now going to the 5 minute. In the 5 minute, we are looking for a small market structure shift or a fair value gap zone, which has this displacement shows prices shifting from an up into a downtrend. And then we trace back to a fair value gap, get an entry with short price targeting the next liquidity zone. That is 1 to 5R. So that is how we look at liquidity of the major. So the major liquidity gives direction. The medium liquidity gives us intraday shift. I'll talk about that also. So let's look at gold. An example of how we should also use liquidity. Now you won't be using the same mode every day. That's why it's always good for you to be able to you should avoid the TikTok teaching which tells you use one single model. It's good to have an edge in different models, but you should make sure you understand when to use them. So someone can say, yes, focus on one model. It's good, yes, so that you can become very good at one model. But you should be able to identify when it will work or when it will not work. So liquidity models, FBG models, order block models will only work when they are there. Okay. For example, in this model here, to realize there is no liquidity model here, we're not sweeping any lows. You're supposed to be able to identify these things very critically well. So for us to have an ability to go up using liquidity, we need to sweep liquidity, then we continue pushing up, isn't it? Targeting higher zones. So you realize that price has got to sweep these lows. Then we now say we have swept liquidity. Okay, this is now liquidity. Liquidity is orders. So if orders have been paired off and taken off, then we can now say price has been swept. So now we can now expect continuous buys to upside, targeting more liquidity on the opposite side, which is this highs up here. So price has swept this liquidity zone. This liquidity zone on a major level is referred to as a daily liquidity low. That is a daily, maybe previous day's low to push up, or if you want to go down to the previous day's high to go lower. So here you realize that price did not sweep this low. Using liquidity model, price did not sweep this low, right? Price did not also sweep this low. So these are not liquidity models. This is what I would call the aggressive schematic, because price is extremely aggressive. So the models you use won't be liquidity. You'll be using things like the lower time frames to get continuations to continue going up. You won't wait for a sweep of a low. Even if you were to check this, price does not sweep this low. So it is not up to you to control whether price should do it or not. No, that's where discipline comes in. But you wait and price confirms it for you that for me to go up, I want price to come and take this previous candle's low. I go in a lower time frame, I get a reverse up, then I target the opposite side of the candle. That is using liquidity. So price does not. So now let's talk about how we would trade using liquidity on this particular gold. So now if you realize very well, price keeps on reversing or targeting lows and highs. So the very first point that we would look at is, for example, when we want to continue buying this price, or where we would expect buys from this price would be this low. This would be the first area, right? These lows here. That price comes, then reverses, but price did not reverse. Why? Because it's a deep premium. It's very high at deep premium. It has also given us a shift. So this price up here reversing to the upside would be tricky. Although gold is possible, it will be tricky. So how do you confirm that price won't reverse from here? You confirm it in a lower time frame. It must give a market structure shift after sweeping those lows. If it does not, it means price is still willing to go lower. As simple as that. So for example, this particular line here, if we are to go to a lower time frame, you realize that we did not have any clear market structure shift when price reached this zone. You see that there was no clear market structure shift here. Price came deep, gave us a false market structure shift, but it did not complete, because the real shift would be close above these highs here, right? For you to say this is a shift, this is the higher created this low, so we need to close above to continue going up high. But then it does not, so it gives us a false market structure shift. So now how do we confirm that price is going to reverse? We go back to the daily, again mark another zone which price should be able to confer with. So if I'm to go to the daily chart, which other swing point is eminent here? We have this swing point here. So if you're saying that we're going to reverse those swing points, why didn't price reverse from here? We also go to the 1 hour chart and confirm if price would reverse from here. Okay. But then overall, if you go to the weekly chart, you realize we're in a bearish market, right? Bearish, extremely bearish. So price was targeting more lows or more discount price. If we're using things like the gun box, you realize that this is where premium, the real low is, right? Here to here. I'm to get this, and then I mark this. So discount is here. So buying off from premium will be tricky unless price is very aggressive. But it is willing to go short, so it goes down to discount. At discount, what does it find? There's a fair value gap zone here which can hold price. This zone here, the previous week reacted on. So on the daily chart, so price reacted on this zone. But then since we are using liquidity, let's not use the PDRM mode. Let's focus on liquidity. So now, this is another low, very clear low we can see during this price action. So clear low is here. So this is another sell side liquidity also. Sell side liquidity. So what does price do? Now when price pokes into this liquidity, we again do the same thing. You see the difference between this and then this? This price closes with a body and shows extreme strength down. But then this one, price pokes in and then gives you a strong rejection. It shows that price is willing to use this zone as a possible reversal zone. Liquidity, we're looking at major liquidity being reversal points. The price sweeps this liquidity, then we go to the 1 hour chart to see how price pokes off there. So when we bring back our sessions indicator to see, because we want to make sure our entries and sessions, so price drops into our daily liquidity zone, and we are waiting to see how price reacts on this particular zone. So price taps into the sell side liquidity and begins to push to the upside. Now, in a lower time frame, you're going to get an entry here, but then consistency, you should be very careful, especially if this kill zone is coming to an end. See, the kill zone, which is London session, is coming to an end. So you want to avoid taking trades outside the kill zone. So the kill zone is coming to an end, price reversal closes. What does it do? It leaves us here with a fair value gap, this gap here. So you want to take your trade in the New York session rather than the London session. So price reacted on the sell side liquidity is beginning to reverse. We now want to enter the trade in this New York box, which is at 4 p.m. Ugandan time. So what do? You now want to start looking for opportunities. Now, if you're using the 1 hour for entries, there's already an opportunity for you to enter from here. But then let's use the 5-minute chart for simplicity. So the 5-minute chart, we're going to look at that particular same zone that price has reversed off the fair value of this particular zone here, for us to get a sniper entry which can mitigate our risk. So price came from this liquidity zone here, this liquidity zone which we are looking at. This liquidity zone pushed, you see it's above this 1 hour zone, reacted here, but reacted outside the kill zone, not trade yet. Make sure all your trades are inside the kill zone for you to avoid manipulation of price. Kill zones help us with volume because kill zones have the most volume of price. So if you're able to take all your trades inside this kill zone box, you're going to be much safer. So the New York kill zone is going to be this particular time in price. So this at exactly 4 p.m. Ugandan time, that's when we start seeing that the kill zone begins. So you start looking for your entries inside here. After price has already taken the major liquidity, reverse the upside, you start looking for entries here. So now price pushes upside, reacts again on this same zone, these places. So what are you looking for? You're going to be looking for opportunities here. There's so many opportunities for entry here. We begin from down here. When the kill zone opens immediately, the first entry is going to be this order block. So you're going to mark this order block as your area of interest. Or if price continues popping up, we can continue trailing our zone into this order block here. But let this be, because this is the most discount order block. From up here to this zone, this is the discount. So price could rally to retrace back. So the first entry is going to be here. It's also paired with a fair value gap in the strong zone. So this, using a lower time frame like this, would mitigate your risk and maximize your reward. So this is your long opportunity from here. You're targeting a risk rate of at least 1 to 3 RR, but you can target your liquidity zone if you really want. But then I would advise always 1 to 3 RR or 1 to 4 RR. So you put here, and then with gold is very volatile, so it can only give 1 to 5. So this is a decent reward to get from here. So you've taken your trade off major liquidity. You've not taken it off medium or lower liquidity, but you've taken it off major liquidity. This helps you to avoid manipulations during price. And also, if you're trading using liquidity, most times, even if you're having a wrong bias, you're most likely to at least get some pips. Reason being, the market is fractal and keeps moving in waves. So if price takes, if you're in a wrong bias of the market, but you're taking a trade off major liquidity after market structure shift is confirmed, price could give you at least some piece before it reverses off against your trend. Okay, so that's why major liquidity is very key. Or trading using liquidity is very key. It really helps you a lot. So that is to do with the major liquidity. Then let's again look at another example using USD/JPY. This is USD/JPY. I'm trying to make sure the pairs are diverse so you can look at different opportunities, different pairs. So if your person trades, for example, USD/JPY, and if you don't trade, you can use it as a case study as well. I'll delete this. So let's look at liquidity. There are so many opportunities for liquidity here. Remember, when we're in a bullish market, what do we want to do? We want to take previous day's lows. Without first taking previous day's high, that's another thing. But we shall talk about that in another sort of session. So while price is pushing to the upside, let us look at the price action here. When price is pushing to the upside, it used what? It used the order block. So this is not liquidity model. This is an order block model, or PDRA model. Tap the order block, bought. Then how did this price buy this day? It used liquidity. It tapped this sweep. When it swept this low, this is the previous day's low, and it is in a bullish market. When it swept this low, we're in a daily chart. It pushed to the upside, right? So same thing here. When price swept this high, it sold, right? Very easy. When price swept this low, it bought, right? As simple as that. When price took away this high, and this must have been some news. It's Friday, September. Must have been some news. It dropped. Same thing. When it took this low, it bought. So let's look at this example again. How will we take a trade on this particular day? Your daily chart, the role of your daily chart is as simple and as clear as direction. So after you have taken previous day's low and your structure is also aligning that we are in a bullish market. As you can clearly see, we're in a bullish market. So after price taking previous day's low liquidity on a daily chart, what is your role? Your role is to go to a lower time frame and get a market structure shift. So this is why we swept liquidity. So we go to the 1 hour chart as our first chart. When I'm trading, I stop on the 1 hour chart because I've backtested and I've gotten more familiar with the market. But then if you're not very familiar, you need to even go to the lower time frame. So this is our previous day's low, right? That we marked on the daily chart. If I can write it again. So liquidity makes your trading very simple. You can get as many opportunities as possible because you're using the right direction of the market based on the higher time frame. So previous day's low swept by this day. So we shall call this previous day's low sweep. So previous day's low sweep is here. So price swept previous day's low. So after sweeping this previous day's low, what is your role? Go to the lower time frame and see if we have a market structure. That's the next thing. Sweep previous day's high or low, go to the lower time frame, confirm if the trend will hold by seeing a market structure shift. So if I can go to the 1 hour chart and then see this same zone. So price clearly swept. So when price swept now, I'll put my session indicator and see I want to take my trade inside the kill zone, not outside. So I'm going to put my sessions indicator. You can clearly see Tokyo session is one which swept previous day's low. So I want to enter my trade in London session because that's when there will be volatility. So when the sweep is complete and displacement begins, I'll now go to the 5-minute chart to look for an entry in the kill zone. So I go to the 5-minute chart. I go to the 5-minute chart. 5-minute chart. I really hope they will give us now. Or they have denied us the replay. Goes to the 1 hour. So it's only for the premium version. So, but we can still see it from here that let me check the daily. Yeah, so they didn't give us this low. So let's look for another opportunity. Okay. So the same thing is gonna keep on happening here. When price wants to buy, it will take the previous day's low, continue pushing up. When price wants to buy, it will take the previous day's low, continue pushing up. On this particular day, it did not take the previous day's low, but it took the previous day's high. It sold. Then again here, it took the previous day's low, it bought. So that's why we believe this is an algorithm. Bought. Then here also we see a sweep of this low and bought. So let's see if they'll give us this replay of this low, its most recent low. So this is previous day's low. Now you're adding structure onto it that we are looking at. We're in a bullish market. Previous day's low. So previous day's low is here. When I go to the 1 hour chart, I want to see how price behaves around that zone. So this is previous day's low that we marked. The same thing. Tokyo session, then it swept it. So if you're a person who trades in Tokyo session, you can benefit from this price action. This is around 6 a.m. in the morning when you're going to look at Tokyo session kill zone. So the Tokyo session kill zone begins at 3 a.m. Ugandan time. So if you're a person who likes trading the early session, yeah, this would be a good trade. But if you're not, still doesn't mean that you wouldn't get an opportunity. There's still more opportunities here. So price taps in this zone in Tokyo session, begins to reverse. So if you don't get an opportunity here, you wait for an opportunity in London session. When London session begins here, you look for 5-minute opportunity for a continuation of that same trend. So I hope they'll give us plan. Yeah, our previous day's low is here. Also, our power plan is. Let's even a closer date to the most recent price action. Need to subscribe to get many more candles. So let's look at the most recent price action here to avoid that limitation of our candlesticks. So this same thing, but you go to a lower time frame, get a market structure shift, deliver price to the upside. Same thing here. Let me get one that can give us recent price action chart. So this particular day, price was able to tap into this previous day's low in the daily chart. When you go to the 5-minute chart, it will give us an opportunity to trade, but I don't know if they will give us. Let me see if the candles will reach. Yeah, finally. So here they were able to give us data. So if this is previous day's low, all that we're doing is coming to the 1 hour and looking for a market structure shift. We also put our session indicator on. So we tapped into the zone in Tokyo session. So we see how we can benefit from this price action. So I see here we had a consolidation day, some sort of choppy price action. You can see it's not a much of a very big trend, but still there was some price action in it. So price consolidates within this zone. It has an FVG on the 1 hour chart here. which it leaves behind. So in London session, price pushes up but does not give us an entry. It taps into this fair value gap and then an opportunity comes in New York. So let's see how the opportunity will be there in New York in the 5-minute chart. So the 5-minute chart will give us an opportunity for entries in this particular price action. The power plan is here. Trading is not for the weak. Supposed to subscribe. These guys have limited the plan there. Let's use this one. One is more recent. Or let's use this one. This is closest. I think this is this particular week. So let's look at this one of this week. So this sweep of this previous day's low. Reason being as to why you'll be confident of buy is because you're in a bullish market. You are in a bullish market, so you expect continuous buys. Break of market structure keeps on happening. This is a boss. This is a break of market structure. Boss. We have another boss here. Break of market structure. All these confirm that price is still moving in a bullish market. So this is boss. This is top. So boss shows bullish market price action. So this means that price is still in a bullish market. So if price is in a bullish market, like we said, if price is doing something like this, breaking highs, respecting lows, breaking highs, respecting lows. Now these are trend lows, not daily candles. See, these are a number of candles in a wave. So this is a wave. With ICT, we use more of candles than the market wave itself or trend. We use the trend, but we use the trend to guide us on where to trade, but not, it's not going to be a complete barrier to you looking at the candle. So you see this particular zigzag wave is what is happening in here. Bullish, retracement, bullish, retracement, bullish, retracement, bullish. But then inside this same bullish, we have bearish. This is a bullish market trend with a retracement, expansion, retracement, expansion. So for us to continue the expansion, we use candle lows, sweeps to continue pushing higher. I really hope that makes sense. So for price to continue pushing higher, we need to break market structure. We combine structure with liquidity. So liquidity, this is boss. So this is boss, that is break of market structure. This is also boss, break of market structure. I hope you know what the boss. Boss is simply when we break those highs. See the swing highs. When you break above with a candle body, not a wick. There has to be a body close above here. It shows a boss. The price has a broken structure. And when it fails to close with a body, that's called sweep. So for example, this is not a when price sweeps like this, we can expect a reversal to happen. For us to confirm price is going to continue going higher, it has to close with this body here. Then this becomes a boss. This as well is a boss. This is a boss. So price creates a boss, a boss. What next? This becomes the next boss, isn't it? That's very clear. So this is boss. So if USDJPY is to confirm further boss or further buys, we need to see price creating a body close up here. Okay. But then since we believe price is bullish, then we can still expect to buy this price pushing up higher. So what happens is you can see breaking structure with a body, boss, breaking structure with a body, boss. We also want to break, we want this price to do something like this. This new wave, it is currently down somewhere here. We want it to continue up. and then it should do something like come up here, then it breaks, then it shall confirm that price has again confirmed a new boss, right? So while price is buying, how do you use liquidity? We use liquidity of candles. Now we're using candles to continue the bulls. So these are the highest prices targeting by sweeping these previous day's lows. Is not relevant. Okay, so price sweeps this low. So if price is to continue pushing up, it will use either PDRAs or PEP or liquidity. So what did it use here? Here it used an order block to continue pushing it higher, targeting those buys upside. So it did not tap exactly the open, but it used this. So here we're having two. So this is a combination. That's why we have. So it's a combination of this and this because they're almost the same height. Look at it very well. This same. So this is a combination order block. Pushes the upside, retraces the open, displaces the upside. So this is a PDRA model rather than a liquidity model. So now where would be the liquidity model? When we don't use PDRA, we use liquidity. So this is a previous day. Price dropped, consolidated, swept this low together with this order block. So this low becomes our opportunity to buy. So we go to the 1 hour time frame to look for momentum to confirm that buy. So price is here now. Okay, so price is within this particular zone. So we now put our sessions indicator. And then we see. So when price tapped into this zone, it tapped into this zone and then gave us some sort of displacement. Okay. But then here we had a consolidation. And these are things you can't control, but had a consolidation here. So price can still choose to retrace back the same zone it hit. So this is the liquidity. The liquidity zone. So what happens is price taps into this, sweeps this liquidity. So if you want to get an opportunity to enter this trade in a lower time frame, then you're going to go to the 5-minute chart. So you go to the 5-minute chart to look for opportunities to enter this trade in the kill zone, not outside the kill zone. Your opportunity must be inside the kill zone. Okay. So what happens here is price hits this zone, displaces up to the upside. So most times you'll want to take your opportunity from here, but then here it consolidated before it distributed. So you realize not every day is going to be purely quality. You have to admit that you're going to have those days when you're going to have a losing streak. So this could be one of them. Because everything met, but then price consolidated in the same zone and can end up taking your stop loss before it bought. So it consolidated, but then later it delivered up to TP. So let's see how you would have entered here. So if you entered here, you would be looking at, for example, be looking at this fair value gap here as your entry. So you would enter from here and then put your stop loss would be somewhere here. And then you target course about 137. This is USD JPY. But then price will consolidate on your zone. But then if you decide to enter again, then you'll have a new opportunity to enter this trade from New York session. So New York session gives us a new opportunity from this order block here. So this order block is within the same strong zone for us to enter. So if you decide to enter it again in New York session, this is an opportunity that you can have. So this is a 1H4B. So here you'll have USD JPY buy contracts nailed, even after maybe having taken a hit on the previous one. So price delivers according to structure, you've gotten your risk reward there. So you hold the trade for about 2 days. So from this day to the next day of you hold the trade, your risk is going to be below this somewhere here. So this is almost 1 to 7 RR, because you're targeting liquidity of these highs up here, because price moves from liquidity to another liquidity point, from liquidity to another liquidity point. So if you're moving from previous days low, you're targeting previous days high, like that. That's where your targets will be, so you can be consistent with your risk reward. It gives you a better edge. So to wrap up this, the major liquidity controls direction for price, and the major liquidity will be the daily, the weekly, and the monthly only. Then of course the yearly, if you're a person who goes into that. Then medium liquidity is going to be the sessions highs and lows. Asia session high, Asia session low, London session high, London session low, New York session high, New York session low. I don't know if you have people trade Sydney session, but it's not very prominent. Then Frankfurt session, no. So those three sessions have the most volume. So their highs and lows are very key for liquidity. So whenever price taps onto those highs and lows, you focus on getting a market structure shift to deliver your price on another side. As simple and as clear as that. So that is how you go to use liquidity. Thanks so much for attending, and wish you a wonderful trading week ahead. So,